hybrid portfolio. Once again, we welcome our friends Mark and Ron, with whom we are doing this building together, and of course Martin. All three of them, I think, sitting in New York at this stage. Justine and myself in South Africa. Just before we get going, the traditional disclaimer. For those of you who haven't seen this before, just understand that this is purely for informational purposes. We are not giving you advice at this stage, and it's not an offer or solicitation to buy shares. And just for the record, Allbest SA, who is the promoter of this hybrid event, is of course an authorized financial services provider in South Africa. So Martin, perhaps you guys in the States should lead us off on this fantastic news.
Well, thanks, Justin, and thanks everyone for joining tonight from wherever you are in the world. I think it certainly is a turning point for me. It's a very exciting time for us in the US. You know, Justin will explain to you the link between interest rates and the values of properties, and in particular, how important the interest rate driven by the Federal Reserve is in this whole equation. And so yesterday, if anybody knows that the Federal Reserve announced their first rate cut, they also surprisingly announced that it's a very high likelihood that they may have additional cuts before the end of the year. What this signals ultimately is that as rates go down, so the value of property goes up. And so anybody in the space is super excited because this will supercharge the sector, which has really been on the sidelines for the past 24 months. And before we go any further, it affects every single person with any real estate in the entire United States. Even if you've got a credit card, whether you've got a mortgage, whether you've got a car loan, it is dramatic. I know in South Africa, when you've got 9% interest rates and you drop by a quarter basis point, it is not material. But in the US, when you're sitting at 4 or 5%, a few of them is equivalent to almost a 20% cut at times. So I'm going to bring in Mark and Ron. And so let's bring in Ron, who loves to talk about numbers, to kick off this discussion. Ron, what does it mean to you guys in your real estate portfolio where you've got some really significant assets in the hundreds of millions of dollars?
You mean in terms of interest rates reductions?
Yes.
Well, I mean, I think the one thing that everybody should understand is when it comes to real estate and interest rates, the reduction in interest rates, if you're holding assets, is a tremendous, it's a really big plus, because believe it or not, when interest rates drop, obviously the price you can sell your assets increases. So it's an inverse reaction. So as interest rates go down, the underlying value of your real estate goes up. That's the first thing. The second thing is that maybe we can be more opportunistic in our acquisitions. The idea is to buy an asset and of course have as much spread between what you're buying it at and what the interest rate you're paying, which increases your cash flow. So it's a very, very important trigger and mechanism here in the United States, and as it is probably around the world in terms of real estate. I think the most important thing I would like to get across to those that are listening today is that there's always a lag. And what I mean by that is sellers in the marketplace right now still feel like interest rates are slightly higher. So allows us to buy things today and over the next couple of months at a relatively good price. And then when it catches up, these assets, as I said earlier, will increase in value down the road. So it's a really, really, really good time to be in the market right now, because we can capture that lag between sellers understanding that their assets are worth more and what we do today.
And then I think I just want to bring in the large players who, you know, really have billions sitting on the sidelines. And for them, coming in with their equity and wanting to pair it with debt, what they are wanting to do is to hopefully get slightly lower debt, which, as Ron explained, you know, makes the numbers more juicy and beneficial for them. So everybody's been waiting for this first turn, for the signals to say, right, now it's time to get back in the market. So it was a huge day. It was celebrated across most real estate sectors in the US. And so we look forward to seeing where this goes in the future. Mark, do you want to add anything to this discussion? Because I know that you in particular have also been watching this like everyone else.
Sure. First of all, thanks for inviting us. You know, again, as Ron focused on, there really is a lag indicator that it takes time for sellers, even though they may be out in the market selling their assets. It takes time for that adjustment to go through. Real estate has always been a lagging indicator, and it also works in the inverse. When rates go up, sellers have a high expectation for their pricing in terms of prices, and when buyers go in, they want to pay less because now they're financing these properties at a higher cost. So it works both ways to some extent. And the other thing to be cognizant of is for those people who own existing portfolios, you know, we're buying effectively long-term contracts. We're effectively, when we go out and finance something, we're buying something that includes debt that's priced for 5 years, 7 years, 10 years, depending on the kind of debt you place on it. So in some cases, what banks do and debt institutions do, they'll make it very difficult to go out and refinance. So, and that goes back to why there's always the lag between a rate adjustment, because sellers can't always hop out into the market immediately, even though they want to sell because they feel like the rates have dropped and buyers are going to pay more, because they may be tied to loans that have very high prepayment penalties. And those prepayment penalties only get worse typically when the rates drop. So there's a whole series of different types of variables that come into play. But overall, as Ron said, it becomes a very interesting, nuanced point to hop into the market now. Not that you can always try to time real estate, but in this particular juncture, if you can go in and acquire stuff that inherently has good value, you do get a little bit of an extra pop to it.
Thanks. Justin, back to you to take us into the next set of slides.
Yeah, absolutely. I think, a lot of questions for us specifically because we've already been in healthcare, and I think Ron and Mark, you guys have got a lot of great things to say about our healthcare portfolio, and that it's a tough space to be in compared to industrial. But, we did quite a lot of research into industrial and had to build up our own hypothesis as to how this thing would perform. And I think when it comes to real estate, there really are, these four significant levers that you have to consider. And obviously the first one is interest rate. The second thing that is quite interesting is transactional velocity, which is the amount of property that is actually being traded in the market. And what is interesting is that has a higher correlation to cap rates than, in fact, interest rate does. But of course, there's a relationship between interest rate and velocity at the same time. But I think, just remember that for a second. Net operating income, that is the income that you earn from the rental of the building, less your expenses, but not your cost of debt. And then ultimately your demand and supply in the market. And I think we're going to have a quick look at these, guys. And I feel like I've got the experts up here. So guys, if you want to chip in, Ron and Mark, please do. But I'm going to run through these things quickly because these are some of the very important points that we show investors that are trying to understand why we are attracted to this particular category of real estate at the moment. First of all, a little bit high level. But if you look at this graph, first of all, the dark blue is industrial. And it's effectively the cap rates over time. And light blue is BBB corporate bonds. Let's just call that debt because obviously it follows the same sort of trajectory. And you can see from this that in the good old days, there was a very, very nice spread between what you could buy the building for, in other words, what you earned out of the building, and what you had to pay as debt. And these good old days here, you could really, really make a fantastic deal, fixing your debt down here at the low ends, and of course, buying a building up here and living off this delta. As Mark said a little bit earlier on, there was a terrible period, as if you will remember, the GFC, where the whole global financial world nearly turned on its head, and that's when things inverted, and the cost of the buying the building was significantly less than the cost of debt. And obviously, what happens then is no one's buying, and certainly if you own a building, you're not going to sell because there's no one buying, so you're going to have to give it away for nothing. And it's happened again. It's just happened now. And when did it happen? Just after COVID, 21, 22. What happened is it inverted again. Price that you could buy a building was less than it cost you more for the debt than you would actually earn from the building, just to put simply. So I think you can understand we've been through this long period, and look at the length of the period compared to the GFC where it was inverted. Just an interesting graph. Let's talk a little bit about the other thing that is probably a result of that, guys, and that is that it has been very difficult to refinance buildings, and there's certainly been no one refinancing or trading because of the difficulty in finding a buyer. And so a lot of debt has been pushed out. And there you can see nearly $1 trillion of debt is rolling over this year in 25. What does that mean? Is that there's a lot of sellers that are sitting on the bench saying, hey, we got to get our properties onto the market, or we've got to refinance them for another 5 years and have the prepayment penalties. So this is one of the reasons why they say that there is going to be a lot of transactions across commercial real estate. $1 billion has to be traded, refinanced, or moved on. So I think this is super interesting. Velocity obviously is completely correlated to cap rates, which is the price of a building.
Justin, I just want to say something that, the previous slide you showed went up to 2024, where you saw merging between essentially the bond rate and the cap rate. And just, if you push that forward to where we are today, debt has now come down to levels where we're getting pricing in the 5, but you're going to see from the deals today that we are getting deals at like almost an 8% cap. So we're back to that nice days of the spread. And what's actually happening is it's being exacerbated by this exact graph you see on the screen. Because when suddenly people have to sell, they're more accommodating on what they sell for, which is the opportunity to go in and buy these great assets and still be able to get good price debt.
Absolutely, absolutely, Mark. And this is a really good indication of how this correlation between the volume of real estate transacted and cap rates, because you can see over time, And again, the blue this is actually multifamily, so it's apartments, but it tracks exactly the same across all commercial real estate, really. So this is the cap rates of the building running along like this. And this, of course, is the number of transactions in volume. As transactions go up, so the cap rates come down. And likewise, up, down, all the way through. And as you can see, we've just been through this period here where transactions have collapsed. And of course, what's happened? Now you're getting, of course, cap rate starting to turn up to 2025. And so what does this mean? It means that we're going to have a significant amount of cap rate compression as a result of the amount of transactions that are happening on the market. This is getting into a little bit of politics here. I don't know about your politics, Ron and Mark, but we won't get onto that right now. But I like to show this graph because everybody says that, oh, you know what, this whole conversation about more manufacturing happening in the US is just a Trump thing and it'll pass. The fact is that this graph here is actually going up to 2024, mid-2024. And the big circles effectively are billion-dollar investments in manufacturing. And this is not pie in the sky. This is actually stuff going into the ground. So you can see that under the Biden administration, there was a massive amount of industrial development happening already. So number one, the demand happened before Trump. It wasn't Trump. But you have to consider this, that although Trump talks about 7, 8, 10 trillion dollars of investment that's been promised, in our investigation, we can see between around about $3 trillion of stuff that's going into the ground. So that is a significant amount of investment and something that will absolutely create a demand, whether we like it or not. There is a counter argument, and I'll put it on the table because I know some people might be thinking it, and that is that there are companies that rent warehouses in order to do distribution and import from China. So that will, in fact, cause some negative impact. But let's forget about the politics for a second and just look at the impact of e-commerce. So e-commerce, you can see these growths on the left-hand axis. These are billions, and you can see that the growth is absolutely phenomenal in the amount of e-commerce that's happening across the United States. And in 2020, you will see that COVID, we had that massive jump, and it caused a problem. Why did it cause a problem? It caused a problem because for every 1 billion of e-commerce spend, the number is about 1.2 million square foot of warehouse space is required for the logistics. So can you imagine what happened here to the demand for small cap logistics? It's really gone ballistic. And this has caused a dislocation of the market. So as I say, forget about any of the politics. Just look at normal demand that is absorbing anything that comes out in the market. So I guess then the next question is, well, when there's a shortage of supply in anything, people step into the market and they manufacture. And effectively, that's what we do. We buy old buildings and we reconvert them, like Ron and Mark have just done with a very interesting building, but we won't get into that right now. Just before COVID, you were building at $162 a square foot. This is December, look at that, 2020. And then the builders started moving into the market and building like crazy, but at the same time, inflation started to move up. And now, what does it cost to put up a warehouse? $234 a square foot.
Justin, if I can jump in over here and just say also that this year's numbers haven't come out yet, but given that Ron and Mark are actually doing a number of very large deals, I think that we can almost guarantee that it's well above 300 at the moment right now. And that's the reason why everybody's trying to get their hands on well-priced smaller buildings, because it's commensurate with the rent. Remember, if you build for 300, you've got to charge 3 times as if you bought for 100. That's just simple maths. And so maybe, Mark, I mean, you love to get into this whole discussion around, construction costs. What's your experience been over the past year and why it's so problematic for people to construct?
It's just, as you're outlining here, it's just simple costs. I mean, it's not economic for most firms, for most mid-sized businesses, which is the heart of the U.S. economy, to pay to rent buildings that a landlord can afford to rent if he's paying $300 or $250 a square foot to build. In other words, if a developer is spending $250 a square foot, which is how we price things in the United States, he basically would need to rent that building for approximately $25 a square foot, or 10% cap rate, given all the risks associated with ground up construction and the costs and the timing issues. That number is huge, huge compared to what markets are typically priced for on a rental basis for existing building stock. I mean, our building stock may range from, on a current existing buildings, anywhere from $6 to $14 a square foot. So when you're talking about $25 a square foot, it literally puts a complete halt to construction, which is basically what we've had, except for the large public companies that can afford to build their built-to-suit buildings to suit their particular needs. Speculative construction for developers like ourselves to go out and build a spec building for industrial really has been completely hampered and diminished. And you compound that with the high cost of money or the high interest rates, it even becomes worse. So that's why it really becomes interesting in terms of something that Ron and I have done in terms of our focus on existing building stock. And not only that, these industrial buildings are not cheap to build. Besides the fact that you're seeing $250 to $300, they're very intense in terms of infrastructure, in terms of electrical needs, maybe air conditioning needs, maybe floor load needs. So those all add in to the cost to construct these buildings. And it also takes a lot more time to construct these buildings. And we're also putting in a lot more parts and pieces to these buildings. So whether it's upgraded electrical systems, those switches, those breakers, those transformers take more time to get from the factories that produce that stuff. So effectively, it takes even longer to build a building than it does to take the generic warehouse distribution building, which is just storing goods. So there's a nuanced difference between manufacturing and logistical buildings that also we'll talk about a little, that we can talk about a little later.
Perfect. And Ron, what is the typical kind of price that you guys are looking to acquire buildings at per square foot, or what you've been acquiring more or less over the past 6 to 12 months?
I mean, it's hard to say on a per square foot basis. It really depends on the geographic locale, quite frankly. Something might be of value in one area that's $100 a foot, and something may be a value of $150 a foot. So it really depends on where you're buying, quite frankly, Martin. What I would like to add, though, is one of the most critical things about what we're doing and buying industrial real estate is that it's like any other asset in many regards. And of course, then again, it's not. And what I mean by that is we're looking for some kind of scarcity. Right. The US population has tripled in the last 100 years. It was 100 million. Now it's about 350 million people. And as the population has increased over the last 100 years, the major cities that are fairly dense have become even denser. And everybody still wants to be in a major city, and they want to be in the locales around the major city. So what we do with you guys, and hopefully your investors that would like to join us, is look for those areas where land is, of course, they don't make any more land, as they say. We're looking for good locations and areas that are dense and to continue to grow. And if we do that, I think we'll all be successful. That's what I would say.
Excellent.
Thanks, Mark. Ron. Yeah, so I think just to go full circle, yes, guys, this is COVID 2020. And as I said, what happened is construction in the industry at this stage, there was a massive shortage, and clearly the builders came into the market and built. Then you had the inflation cap, and builders left the market, was no longer viable. Can't charge $25 a square foot. The average industrial guy is going to rather go and find something secondhand until he can't. So the net result of that is that very little new inventory is coming into the market, which once again talks to the shortage of supply and the reason why you can't just flood the market with new buildings. So yeah, I'm just going to finish very quickly, guys. Death by PowerPoint. I had to take you through it because some of these things are very important. There are a lot of buildings across the industrial spectre, and I don't want to get into the details of all of them. This is what I think you were talking about earlier on, Ron. This is the big, the Amazons of the world that can build themselves a data center, and they don't really care what it costs. It's just got to be out. On the other side of the spectrum are these ones here, which is of course your small bay buildings. In fact, for those of you from South Africa, small bay for us is not small. This is 10,000 square meters. If you want to put it into metric, that's a pretty big building. But 65% of the leasing activity is obviously happening in this sector here. And if you look at vacancy rates, here's small bay over here. And of course, you can see that there's very little vacancy. And consider taking out cities like Detroit and places like that, where maybe there is a lot more vacancy. And I think that in some of the submarkets that Ron was talking about that we want to go into, there is nothing. There is nothing. There's no land available for new builds. And of course, this is the opportunity. Now, look at this one here, rent growth. And I think maybe, if we can come back to you guys, I don't know who wants to talk to this, but why has there been such substantial rent growth? I mean, look at Atlanta, 8.5% rental growth in industrial.
Yeah, it's literally, everything. If you take into account everything we've just said about the difficulty of having of bringing new product in terms of supply and demand. We've had an increased supply of industrial needs in our market. We've had building a growth of logistics, which has taken over some of the pure manufacturing buildings have turned into logistics buildings. So it's become effectively the perfect storm in terms of demand. So you have all these demand issues going on that drive all these urban markets or suburban markets, and you have a lack of new supply. So the only thing that's going to move is your price point.
Spot on, spot on. I think
Justin, I just want to come in here and I just want to give a real story. I've got a friend who runs an injection molding business in Long Island. He's got quite a big factory. He produces all stuff for the US military. And literally, his house is nearby. His kids go to the school. He's been there for 16 years. The landlord just put his rent up by 5%. He said, I'm completely strangled. I have no option. Look, thankfully, he's highly profitable, makes a lot of money. But that's where I'm saying, you know, the medical sector, because you've got large dominant players, it's the inverse scenario. They were pushing for 2 to 2.5% increases. And that's the way it's been forever. Whereas in this particular sector, it's becoming quite common to get 3 to 4% on average, which means over a 5-year hold, you're increasing the pure value of your building to 15% based on increased rental or 20%, which is significant in terms of your overall returns.
Absolutely, Mart. And yeah, coming to this last one, and I'll be finished with it as my PowerPoint. But really, guys, if you look at occupancy in the office sector, we know that it's terrible. Remember, we do medical office. It doesn't really sit in this category. In fact, our occupancy is actually pretty good. We're sitting at, what, 7% vacancy at the moment across our medical portfolio. But look, this was obviously 2022, so you know it was a particularly tight period, but industrial was the best performer here. And there you can see, you know, roughly where it's at as far as vacancy is concerned. And this is really, you know, comes down to the hypothesis. Do you want to play in an area where there's no supply and lots of increasing demand from various different sectors, or do you want to play in an area where there's tons of vacancy, lots of distressed buildings? And I think that, you know, this is really why we are where we are. And so, Mart, let me hand over to you. What is our plan? Tell us about what we intend to do with this information that we've got.
Perfect. Thanks, Justin. And so, you know, one of the most important things is that, you know, these opportunities in the US real estate sector come about now and then. And it really is a convergence, as you've heard tonight, of so many things. So we intend to build this portfolio and fulfill it. We believe it's a unique opportunity. And a lot of people have been sitting on the sidelines. So we intend to get in now. We've already got 2 assets out of the 8. We will have a maximum of 10 in this portfolio, together with Mark and Ron. We intend to put it all together, bundle it. It's between $50 to $70 million in total. You always end up with 2/3 debt and then the balance in equity. We'll get to that just now. And, you know, once you diversify it across multiple states, multiple tenants, multiple towns, it creates tremendous resilience. And the question is, why are all the big players not stepping in? Because you'll see in these transactions, Mark and Ron in particular have done enormous deals in the past with big players. And their general consensus is we don't even get out of bed for under $10, $20 million. It really is that true in the US. And so what it allows is players like ourselves to come together, buy these buildings, put it together in a portfolio, and they then get snapped up by the bigger guys. And it's just a consolidation play, whether it's overseas in countries or whether it's in the US, it's the same thing. The bigger guys wait for the smaller guys to do the hard work, and then they pay them a small premium. Why? Because their funding is much cheaper. They're getting money directly from the NASDAQ, or they're getting money from insurance companies or pension funds. So their margin is always much better. They can pay a little bit more. And so if you look at the screen right now, you'll see we've already got the first 2 buildings. We intend to get the other remaining 6. This is how it rolls out. Once we are at that level, even if it's in the next 6 to 9 months, we are closing it. And that is it. We will then maximize the value, and you can see how it all pans out. That 7% return at the bottom, you'll notice, that is the return that we are going to be paying out to investors. It does not mean that that's all we are generating. The balance goes into building up reserves. And that is essentially the view of the portfolio from a conservative perspective. I'm going to hand over now to Ron and Mark, because the first building, it was extremely coincidental. We actually both found the building, and we both fell in love with the building, and we both contacted the broker together, and we had a discussion 4 days later, and we realized we were both negotiating on the same building. So over to Ron and Mark, why we think this is such an incredible opportunity we both came across.
Mark, you want to take it? You want me to take it? Huh?
Whatever you want. We can talk over each other.
Which is what we
usually do.
Right.
Well, you know what? I'll say one thing. I'll say that a lot of people over the last couple of years have invested in multifamily, and if everybody understands why people invest in multifamily, is because they have, as Mark always likes to say, diversity of tenancy, right? So when you buy a multifamily building, whether it's 100 or 200 or 30, or you buy an medical office building with multiple professionals there, you always feel like in some way, shape, or form that you've hedged your bet, right? You can lose a couple of tenants and so on and so forth. Well, we run into a building with, I think, 4 tenants, but in the industrial sector. So what we have here is a very, very a crucial building for these manufacturers and service providers within this building. We have a multitude of tenants here. We have a tremendous locale near the highways. We have a building that has been operated fastidiously. The previous owner, the current owner until we close, has done a tremendous job operating this particular building. It sits by retail and also multifamily. So when we did our research and due diligence, we found out that this thing actually fits all the criteria. A multi-tenanted industrial building that has been well cared for near the highways. And one of the things that always struck us here is that this building has never been vacant. So what does that tell you about the building? It tells you the strength of the market, the fact that you can feel comfortable buying it. And the other thing I just want to get across to everybody on this call is when you buy industrial, it's not like you're buying a multifamily, right? In a multifamily, if you want to move, you pick up your bed and you move. And in these particular assets, the tenants invest a lot of money. So we call them sticky tenants. So this is one of the best deals that I think we will ever have done because of its location, because of the tenants, and quite frankly, because we're buying it at the right price. And we've got tremendous leverage in terms of the percentage that we're going to be borrowing at. It's a wonderful deal. And that's what I
Yeah,
would say.
and I mean, you can't understate when you're buying it from a fastidious seller. The seller has owned
Is
this
that
building for
is
13
that the
years.
Allendale?
No,
Uh,
yeah. If you could go back to the previous,
Go
just we'll
back to the
focus
previous.
another
Yeah.
couple of minutes on branding. So this is in the Chicago marketplace. It's literally 20 minutes west of O'Hare Airport, one of the busiest, largest airports within the United States. As Ron said, this building's got 4 tenants, but again, the owner, the person, the seller we're purchasing this from has owned it for approximately 13 years. He actually, this is not his primary business. He is not in the real estate business. He actually has a contracting firm, and it just became too much of a management thing in dealing with. He's not a professional real estate owner, so in terms of dealing with all of his investors, he doesn't have the infrastructure set up. And he decided, look, this is not my primary business. That's why I'm selling. But he would drive by this building literally on his way to work every day. And you can just see whether it's the brick pointing that he did recently, whether it's the roof, the replacement of the HVAC, the parking lots, the windows. The other thing that goes to what Ron said about stickiness is we have a tenant in there that's one of the shorter term leases, is with a local healthcare provider that has a clean room in there that's specifically licensed. It has a special type of a license for them to do what's called compounding, to make custom-made medicines for people who need it. They just spent $250,000 upgrading their HVAC system. So even though they have one of the shortest terms remaining, you can hold that in confidence that they're going to renew. It's not 100%, but would I say it's 50%? No, I would say it's probably more than 75%. But those are the little nuances, what we like about that particular building. So let's move on to Mechanicsburg. So this building is in the Harrisburg market. Harrisburg is the capital of the state of Pennsylvania. This one is actually literally what you're seeing right behind this building is one of the largest naval supply depots in the United States. So it's a very up area. And a matter of fact, this started out as an industrial area and it's converted to more of a retail neighborhood. And I'll focus in on that in a minute because it has to do with where we are in the transaction. The first deal, the deal in Downers Grove, the Chicago deal, that one we've already waived due diligence. We're scheduled to close on October 14th. This particular deal, Mechanicsburg, we're still going through our due diligence, and there are still a couple of things we have to work through, and I can go into that in a little bit more detail in a second. But what we like about this particular location is that it's an industrial building, it's an industrial location, but the building's also the area is also turning itself into a retail corridor in terms of necessity retail. Right next door is a large giant supermarket. Right in front of the building, if you go back to that first slide, the building in the lower right-hand corner was actually constructed out of the existing building. Yes, that building is a Rite Aid, a drugstore. This building actually used to be larger. If you can imagine it as a rectangle, about 20 years ago, the owner chopped out a large corner of it to create a development site for Rite Aid, and he sold it off and created Rite Aid. Our particular building, the one behind it, is occupied by a furniture operator who sells office furniture to governments, a variety of different governments, both state, federal, and local governments within the Pennsylvania marketplace. And that's the supply source.
If I could just jump in over here, what's quite incredible about Supply Source is that they're the #1 player in the state. They've been around, I think, for close to 40 years. 3 years ago, they acquired the #2 player in the state in order to protect the jobs and everything else. So the #2 player didn't want to sell it to anyone else. They wanted to sell it to, Supply Source, because they've got an amazing reputation of looking after their employees, looking after all their customers across the state. And what's most incredible, Justin, if you can go back 2 slides, I was most surprised when I went there to actually find that it wasn't directly in only an industrial area. If you can see the bottom one in the middle, there's a giant shopping center right next door to it, which the name of the shopping center is actually, or the retail,
Giant
store, the convenience store is actually called Giant. And there's the main road that actually goes through the center of a town. So it's incredibly well located. And they've got a 15-year lease, which is unbelievable. And so we're very excited about this deal #2. We think it's incredible value. To be able to get both these deals at an 8 cap rate is just extraordinary under the circumstances. And hence it's the opportunity to be able to buy deals from small private individuals versus trying to buy from the large players. And I really think on both of these deals, it was all credit to us for having first mover, very quick advantage to get hold of the broker, meet the sellers face to face, consummate the deals before word really got out on the market. Because on the one deal alone, others have come in and tried to buy the deal at a higher price, but we've locked it in already.
Yeah, and there's still, again, on the second deal, as I said, we're still in the midst of due diligence, and like any other due diligence cycle, things come up. For instance, the day before yesterday, we finally got the survey. The survey revealed that a number of the parking spaces aren't on the property that's owned by the seller. So the little nuanced things that we are careful about and that we look at is, hey, what happens when this tenant moves out? What can we do with the building? What are the requirements to bring in a new tenant? What do the local codes say for parking ratios? Parking ratios have to get looked at because whatever tenant you bring in, there are particular parking requirements. Well, with this parking not on our property, what could we possibly do here? So even though we still like the economics of the deal, we're still running through the due diligence in terms of the zoning and in terms of the possible uses down the road, because you always have to look at what's the worst case scenario. What happens if a tenant goes dark? What happens if a tenant moves out? What happens if a tenant files for bankruptcy? How do you backfill that tenant? How do you recover? How do you get that income back into the building? And how are your uses limited? So one of the things we discovered by having that parking out is that actually it does possibly limit part of the potential use going down the road. So this is real-time information in terms of how and the type of due diligence detail we go into. So even though we'd love to have to say that we're buying this building, we still have not completed our due diligence yet to say, hey, we're doing that, but it's all part of the many boxes we check to make sure that our investment meets with our own internal criteria that we're covered for the worst case scenarios that could possibly come up.
Fantastic. Thank you, Mark. And I might perhaps bring you in again as far as the portfolio so far.
Yeah, so I think you'll get a snapshot now of where we're going with this. So the 2 buildings so far, very, very strong fundamentals in terms of your on the right-hand side, 10.8 years average lease term. And when we say we're also going to hold deals for 5 years, it doesn't mean all the deals will hold. We're very opportunistic going forward. If somebody wants to come along and offer us a premium on a building, we would love nothing more than to be able to sell some of these buildings, return capital immediately to investors and some profit. And so just all around, you can see the mix and the diversity. By the time we finish with the 8 or 10 buildings, it'll emulate the same fundamentals of a nice, strong, healthy portfolio. In terms of the tenants, we don't need to discuss it too much, Justin. Suffice to say that the tenants have mostly been there between 7 and 20 years in the DuPage building, extraordinary amount of time. And the building's been nearly 100% leased, literally for over a decade. So incredible, strong fundamentals. If we go to the next slide, Justin. You can see over here, anybody needing direct information, we've got a full Excel model and a pack we can send to you if you really want to get into it. But it just highlights the numbers. It highlights the free cash flow. And what we are expecting, which we have not built in, is that clearly in 2 years' time, if rates have come down even further, what you would do is somebody's already posed the question, if interest rates come down, does that improve your cash flow? Of course it does. So at a time when interest rates start to come down, it's called a refinance. You were paying 6. interest rates are now at 5%, you go to a bank and you refinance at 5%, and sometimes even get cash out to pay back investors. So that's what we will be targeting in the future, as most players are looking at the same scenario. And it's exciting for banks, because banks are always looking for growth. And if they can poach business from other banks, well, that's what they're in the market to do. Justin, you want to add anything to the slide, or you want to move on to the next one?
I just wanted to say that you can see how these buildings generate cash together. I mean, it is really, really nice to know that you're pumping out by year 5, you're 9.5% without any creative underwriting, if I can put it that way. Just understand that certainly from our point of view, we are going to stick to the 7%. We're not going to increase the payout. We're going to rather build up a little bit of ballast. As you know, we've got conservative partners in Mark and Ron, and they want to make sure that there's money in the bank in the event that there's any eventuality, which of course is a hard lesson that we've learned in the past. Mart, maybe I'll just take this one. Very simply, we are acquiring the cost of the 2 buildings at 13.3. Ultimately, the 2 buildings together sitting at about $14 million. We will get $8.6 million of debt, and maybe Mark and Ron would like to just talk a little bit about debt and the sources of that. I don't know who's the expert there. Maybe you, Ron, because Mark had got the last chance. We will then bring in, between us, Mark, Ron, and us, we will bring in $5.3 million of equity. Ultimately, the way that we see the cash flow working is the 7% per annum, and we expect a 13 to 15 IRR, about a 1.8x multiple. But just understand that this is actually at the fund level, as we call it. It's not at the building level. And at the building level, Ron, perhaps you want to talk about your IRR at building level for these 2 buildings together?
Yeah, I mean, what I would say about the IRR is going to be close to, it's going to be above the 13 to 15%. And there's a couple of factors here. The primary factor, of course, is you, as they say, is you make money on the buy, not on the sell. So we're buying these assets right. Okay, and that's the first thing that we're doing. The second thing that we've been able to do is find inexpensive debt. So there's different places here in the US to go for debt. I'm sure it's the case with South Africa, but you can go to commercial banks, you can go to credit unions, and you could go to life insurance companies. We're very, very fortunate on the DuPage deal to have a life insurance company, which is the least expensive form of debt you can find in the United States, except for some institutional monies that we can't avail ourselves of. So all in all, and by the way, what I should tell people is that we don't have one debt provider. We use a debt broker. They go through the United States, they go through commercial banks, they get the life codes and so on and so forth to find us the best actionable money. And so that's really why we think that we're going to achieve these RRRs and then some on a higher level.
Ron, we've got senior debt on buildings sitting at in the double figures right now, 10% odd. What are you borrowing money at for DuPage?
We are less than 6% on DuPage, which quite frankly, when we underwrote the deal and we negotiated the acquisition price, I think everybody should know this, is we didn't expect a sub-6 number. So it's, if you find us to be somewhat excited about the transaction, it's because, quite frankly, we had modeled it differently. And that's the crux of the matter.
Yeah, I think when we modeled it, we were sitting at between 6.25 and 6.4.
Yeah.
That's where we were. With the quarter basis point, we expected at best 6. Sub-6 just means you can see the banks are coming in already. And that's why we say that this opportunity really exists now. We've been now doing this for a decade. Ron and Mark have been doing this for, my goodness, I don't want to make you guys sound old, but nearly 3 decades. And there really is.
We're not that old.
Mark and Ron started when they were 16 years old, but it really is the opportunity to strike right now. We're super excited about this. What I think is most exciting is that with Mark and Ron, they have a very powerful reputation, as we do, of when we give a commitment and a letter of intent, LOI, we close. And so that's why sometimes if a broker gets an offer of 7.3 and we're at 7.1, they'll mostly do their homework and they'll say to the seller, rather go with these guys. Because there is, unfortunately, a trend in the US that most buyers will put in an offer, then they run around and tout the deal and cancel it. Alternatively, what they do is they go and retrade the seller down the line. We have a very strong reputation. So with us, as Justin had on the prior slide, we believe right team, right strategy, right time, right everything. It's time to really get in right now. We're very excited about this. And we think that after yesterday's rate cut, it bodes even well, or should we say even better than what we originally expected. So maybe some questions, Justin.
Absolutely. Guys, please pop your questions into the Q&A. Thank you for those who have already. It's great that we've got everyone online to answer all the hard ones. So let's go straight to Mark. Do you want to just pick on something there?
So I'm going to throw it out to Mark. Andrew says, how long would the due diligence take on the second building if everything stacks up? When do you expect to close?
So we're probably actually at the point where we're going to ask for, or we are asking for additional period of time, probably another 30 days. So assuming that occurs, so we'll probably close sometime in the middle of November.
Okay.
So 30 days from now, due diligence. And again, during that period of time, if something comes up or we can't wrap our head around, for instance, the zoning issue, the parking issue, we would end up canceling and eating the cost that we've spent on due diligence, but that's part of our business, part of what we do. But 30 days of extra due diligence plus 30 days to close brings us to the middle of November.
Well, the good thing is that in the US also, and the reason why sellers are so cognizant of who they go into business with is because what they don't want to do is at that final point, remember what we obviously asking them on reasonable terms, which any buyer would ask the same things for them to fulfill. And they don't want to start the whole process all over again.
And that's an important nuance situation here because the seller was not aware in this particular case for the second one that he thought the parking was on his property, didn't really look at the survey. So that's an important nuance. And now the seller, if we're not the buyer, he has to then disclose that to any future buyer. So it's whether it's us or someone else, that is now a public fact in effect that and the brokers have to disclose.
The other question that I'm going to answer, Justin, is from Andrew, who asks, this fine partnership between us, is this a one-off or are we going to be doing this for many years into the future? And the wonderful thing is that, Mark and Ron and Justin, myself and the team, we are so perfectly aligned in terms of what do we want to achieve. They've got their investors who are US investors, accredited investors, reasonably wealthy individuals. And together with our investors, we see this as an amazing partnership to be able to buy these kind of deals, build these portfolios, exit and make a lot of money. A little bit about their history. They made other people a ton of cash doing this as their operational team for over a decade. And so, Ron, maybe you want to explain, why did you eventually just decide to leave, considering you were in such a good cushy position?
Yeah, I mean, I had a good perch, and Mark and I were working at a firm together, and there was really, the truth of the matter is, as you said, we were making people a lot of money. I was the CFO and I was the chief operating officer for the company that we were at. Mark was the head of real estate. And the truth of the matter is, Mark and I have known each other for 40 years. And eventually we said, well, why are we doing this on behalf of somebody else? Let's do it on behalf of ourselves. And we left 6 years ago and we went out on our own to do that. And so far, so good. I'd love for people to understand that we don't jump at deals. We look at dozens and dozens and dozens of deals. It's hard to negotiate a good deal. If it's not a good deal, if we don't think we're buying it right, we just don't do it. We just don't do it. The second thing is, in our due diligence, we're extremely rigorous. Okay. It's very easy if you don't understand real estate to make a mistake. Now, one of the reasons that I believe that Mark and I are really a good partnership is because I generally handle a lot of the deal making and the capital raising, and Mark handles the underlying real estate and the nuances of the real estate. I want everybody, on this call to understand what, like, for instance, just the other day in our second deal, Mark found out through title search?
The survey that came back.
What was it indicative of that we're dealing with?
Yeah, it was as I mentioned, it was the parking and the zoning. The zoning wasn't, and again, it has to do with the growth of the area, which is for me interesting because it was originally an industrial area that's transitioned to a retail area. So, but once you're in a retail area, the parking ratios are different. And because the town also changed the zoning to support retail, they took away the zoning to do this type of industrial. So which goes back to that releasing fact if the tenant goes out, and effectively we're grandfathered in, and how do we mitigate the risks associated with that? And
So
that
Mark
became
called the seller.
apparent.
So we spoke to the seller, and Mark said, listen, apparently some of our parking spaces are not there anymore. If this tenant is not going to be there anymore and we have to release it, our new lessee will need X number of parking spots. We need to fix this. And so the point to the audience is, it's not just about buying a building. It's about understanding the nuances of the building, whether it's the HVAC, the electrical system, the foundation, the roof, the zoning, the survey, and the underlying title and easements and so on and so forth. And the point I'm making is, these are all the things that you are investing in when you're investing with us. And hopefully that gives you a sense of confidence.
Yeah, and I just want to mention that Hildegard also asks the question, is this only for 5 years? What happens at that stage if it's generating a lot more? So the one thing we've seen is that there's nothing better than being able to sell a building, make a profit, return it to investors, and then let investors do whatever they want to do if they want to come back into it. And so, yes, the plan is to sell, maximize value, and build the perfect scenario. What you really want to do is create the perfect acquisition for a large player who wants to come in and purchase. And, you know, Ron, maybe, you know, talk about your ambitions of that and your understanding of the market.
Yeah, I mean, we could both. Yeah, I mean, we could both talk about it. Obviously the larger players, the space we're operating in is below where the larger funds in the United States operate. They just don't have the time. They don't have the inclination to do deals that are sub 10, sub $12 million acquisitions, which require equity checks from $2 to $4 million. They don't want to write checks that small. So that becomes a perfect space for us to operate in. And when you start building up a portfolio of those type of assets, then you get to a mass that then becomes interesting to those type of buyers. And as Martin alluded to earlier, their cost of debt is not something that we have access to. They can go out into the public markets or the financing markets and borrow at 4% in today's world, whereas we're borrowing at 5, 5.5, 5, 9, 6%. So that's why it becomes overall cap rate compression. They're supplying investments for pension funds, for state funds. And as a result, they can afford, and there's competition enough in that arena, they can afford to pay at a lower cap rate than we can. So when you mass those type of mini buildings together into a fund or into a portfolio, effectively selling them all out in a single transaction becomes a very unique capacity to compress cap rates.
The bottom line is that what Accretiv wants to do is a terrific methodology. The larger transactions, folks, if you're going to buy something for 25, 30, $40 million, you get 5 to 10 bidders. There's a lot of institutional money in the United States, and those deals get bid up. What we're doing is we're cherry picking the United States. We're picking out assets and we're buying them for 4, 5, $10 million with Accretiv, rolling them up, and then selling them off in mass, hopefully some, maybe not all, to the institutional investors. It really is a pretty solid methodology for creating wealth.
And if you look at the biggest players in the US, I was just going to end up on this, Justin, sorry to interrupt, that, you know, that's how the Blackstones of the world, the BlackRocks, actually ended up becoming such behemoths in the multifamily space. They just went to all the players like ourselves and just bought them all up one by one, and are so vast now. Justin, over to you.
I think, you know, for those of you who've been around in our medical portfolio, you'll understand what we are trying to do by putting everything together in a fund and tie it up in a nice bow and hang it out there for one of those institutions to buy, guys. That is our entire strategy. So just to pick it, guys, we do always promise that we'll get over in an hour, and we are just 1 minute over an hour. So I'm going to quick some of these questions. Chris, minimum investment is $5,000. We're sticking to the $5,000, but I must just mention to everyone on the call that we do have a pref equity offering. It is limited, and the idea is just to get a little bit of foundation for this fund. It's very limited, and that's $25,000 to get the pref equity. The pref equity is 11%. What that means is that you stand ahead of everyone else in the waterfall at the end to get it to get 11%, and of course and everyone else sits behind you in the waterfall. So certainly a very interesting opportunity if you do have access to 25 or more. Hilditch, yeah, Martin, I think answered that. Thank you for that. And then Steve, we will be if there is improved interest rates, why not bring the dividend rate from the current 5% to past 7%? Yeah, Mark, maybe you want to just try and...
Absolutely. So as we said, lower interest rates, higher rental equals increased cash on cash. We'll build a reserve. If there's excess funds, of course, we're not going to hold it because that's very dilutive to your returns. So we will exceed and then pay out more. However, we say to people, let's rather try and under-promise or over-deliver. I just want to also mention that Justin was coughing and splutting away there because he's so enthused about the interest rates. He's just been all day about it.
He's been in tears all day, yeah. Wonderful. Guys, just thank you very much. We are sitting on 3 minutes past. We've managed to get through the questions. Andrew, sorry, how to unlock in the 25K. Andrew, please just reach out to us. In fact, we'll probably find you and we will help you to sort it out offline. But Ron, really appreciate your time. Mark, yeah, get stuck into that DD. We want this building. Just badger them to come to the party. And Martin, thanks for your time in New York, and have a good day, everybody. Good night for you.
Thank you. Take care.
Thank you.